Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend, Barb Armstrong. She's there to facilitate the conversation, keep that chat going, and help to answer your questions. If you're in the recorded version, we're glad to have you with us as well. Leave us a comment in the comments section. I have the opportunity today to fill in for my good friend, Connie Hill, who is out this week and jumped back into a webcast that I taught for a while. So I'm glad that I have a chance to spend a little bit of time here. As we get into this discussion today, we're going to talk about a number of things. I want to talk, first of all, about our 14-7 strategy that we've been talking about. And I think Connie's been keeping going, and she may have changed things a little bit, but I'm going to go back to the way that I've been doing it along the way. Second, I want to talk about the fact that volatility is pretty cheap at the moment. At least it is fairly low. Whether that translates into cheap or not remains to be seen, and what that might mean for index options traders. And then third, at the request of many of you, I want to talk through a couple of ideas regarding zero DTE trades, specifically on SPX and XSP, but to talk about some of the influences of option Greeks on those trades, especially as you get down to the last little bit. So we're here at the last hour of market movement, and we'll get into that. We've got a couple of example trades to talk about today. A couple of quick reminders, though. Everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation of a particular account type or strategy or security or anything else or security type. Remember that past performance, no guarantee of future results. Now, one thing we're going to talk about, equity and index options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of and have read the options disclosure document and understand the characteristics and risks of standardized options before considering any option transaction. It's important to remember that American-style short options can be assigned at any time up to expiration, regardless of whether they're in the money, at the money, or out of the money. European-style options, however, do not have that particular risk. There might be other risks associated with those. So a European-style option, which most of, if not many of the index options that we will talk about are European-style, do not carry with them early assignment risk. And that is one of the things that allows them to be used in some of the strategies that we are talking about, but it also precludes them from being used in other strategies that inability to exercise counter to a long position. So, or exercising counter to a short position. So one other thing I want to talk about, since we're going to be talking about zero DTE options in this discussion today, when trading options at or near expiration, you've got to consider the risks associated with that strategy. Lack of liquidity is one. Significant price slippage, width between the bid and ask spread can be another. Volatility and movement, as indicated by the option Greeks, where profits can disappear quickly and turn into losses significantly more quickly than if there were more time to go until expiration. So that's something to pay attention to. Opening of options transactions on expiration date, also known as zero days to expiration trading or zero DTE options, substantially increases the risk due to that limited time frame for movement and the need for monitoring the trade. So be aware that there is the potential that positions may be liquidated regarding whether they are in the money or out of the money, that a certain circumstance may put a position at a disadvantageous price, may provide potential losses and some transaction costs. So just be aware of that. So probability analysis, technical analysis, fundamental analysis, those are a variety of different ways to look at the market. All of them are theoretical in nature. None of those are guarantees as to future success. Now we talked about stop orders, of course. Talking about stop orders don't guarantee the execution price of an order. Stop limit orders do not guarantee that there is going to be an execution because the price could gap around that limit range. So we're going to be using the Thinkorswim desktop software platform today. Specifically, the paper money version of the platform is not a guarantee future success. Great learning environment. However, It doesn't do certain things. And when we start talking about trading zero DTE trades, um, where orders fill becomes oftentimes a key component of how that order becomes either profitable or not profitable. If we're talking about small amounts, paper trading orders will fill at the midpoint. Live trading, those orders may not fill at the midpoint. They're going to fill based on market forces at the time. So let's pop over here to the market and see what's going on. S&P 500 kind of flat on the day. In fact, only up about 0.27% on the S&P 500 today, net. 0.35% gain, sitting at 77.55. Kind of this neutral movement, but we've seen some very strong movement off of this 7,400 level back up to this resistance, and it's been in place for some time now, 1, 2, 3, 4, 5 days roughly, kind of running under this 77.71, 77.72 level, where we've been running into a little bit of a resistance. Same thing happening today. Not a lot of change over the course of the week, just really kind of a lot of nothing. That has led to perhaps a little bit of complacency. We're kind of down in the final days, the final weeks, if you will, of earnings season. So there's not a lot of volatility, not a lot of news-driven movement here. We've had some data points, but we're past the Fed meeting, we're past the jobs report, we're past CPI and PPI now. So the lack of data may kind of stall this market a little bit. NASDAQ down just a little bit today, but net up, gapping up and then selling off a little bit, running back up to a resistance level, a little bit of positive movement in terms of overall range, but not necessarily in terms of the candle. So some downward push, but not enough necessarily to trigger volatility overall in the NDX. Taking a look at the Russell 2000, kind of breaking out of this little bit of a squeeze here, and maybe breaking out to the upside, and maybe as an indication of perhaps a little bit more risk on across the way and across the board. That risk on perspective kind of coming as a function of those small caps, maybe expressing that as the rotation happens into some of those small cap names. Now, Zink says, hey, how do you find zero DTE trades? Do they work at best at the start of the day? And the answer is generally. Maybe not right out the start of the day when there's a lot of volatility, but kind of in that fat middle section of the day when the market is maybe moving. Let's pop back over here really quick. I'm going to pop back to the SPX, and I'm going to change my time frame here on the SPX. I'm actually going to put this on a 1 day, 1 minute time frame so that we see today's trading, and you can kind of see what's happened over the course of the day. There's been a directional movement in the S&P 500, but that time frame from the start of the cash market, where we got kind of a gap up overnight and then a little bit of a sell-off, that maybe is a tradable movement from the standpoint of maybe fading that gap to the upside. When we talk about that in the futures market a little bit in terms of trading that overnight movement and selling against that gap. So a trader looking at a zero DTE trade and deciding that that was the directional movement for the day might have come in and put in a short option trade, maybe a short call vertical spread up above where the market was at that point, and then looking for that initial move or that continuing move to the downside. Then what we saw during the day, again, that was the push to the low, and then we saw this rallying back up. So a trader who would put that trade in, maybe not coming in at the first couple of minutes of the market, remember these are 1 minute candles, but maybe a trader came in and they put in a short vertical spread somewhere above this level right here, that 77.60, 77.59, 77.60 level, and they sold a short call vertical spread up here in this range above that level, saw the price move right back up towards their short strike close to the end of the day and kind of taking out that directional nature. And that's one of the potential risks of a short trade. I mean, not a short meaning short the position, but a short time frame trade is that if it starts to go against you, there is very limited time to do anything about it. It becomes kind of a directional assessment and let it go. not necessarily let it go, but a directional assessment, and you don't have time to let it adjust. It's not a trade that has the possibility of kind of letting it sit there and languish. It's not, if it doesn't do what it's going to do, it doesn't do what it's going to do. And some traders will just simply take that and take that trade off. So risk management in a zero DTE trade, especially in an index option, becomes a key component of that particular type of strategy. When we talk about weekly options, Danny, when we talk about weekly options, and weekly options just simply are options that expire on a day that's not the third Friday of the month. And generally, those are Friday expirations. But in some of the indexes, especially SPX, NDX, you're going to have daily expirations. And so one of the reasons why some traders like to use these indexes as a vehicle for trading those zero DTE options is because they can do it every single day of the week. They don't have to wait till Friday till that option becomes a zero DTE trade. Every option at some point in its lifespan gets down to that zero DTE time frame. So that's kind of one of the natures of these types of trades. So we'll come back and we'll talk about that. We'll revisit that here in just a minute. Before we get too far into this, though, I wanted to talk about one aspect of what's going on in the market. So I want to bring up my VIX grid here really quickly. And taking a look at the VIX. So taking a look at the VIX today, I mean, we are in the mid 14 handle, just below the mid 14 handle. And if you take a look at where that level puts us, we've got to go back into December, January, where there was some rotation in the market. The market was starting to rally a little bit and then kind of maybe pulling back, where we saw a little bit of this complacency. The last time that the VIX was down below the 15 handle. Here's the 15 handle right about there. And, we've touched on it, but there's been quite a bit more volatility over the course of the last year than there is right now. We're kind of at that lowest point over the course of the year in terms of volatility. Absolutely. What does that mean? Does that mean the market's gonna, there used to be this phrase that we used, and Barb will probably remember this, and those of you that were around at the time that we taught this phrase, you'll probably remember this, and it was that when the VIX is low, it's time to go. And when the VIX is high, it's time to buy, meaning this is a contrarian indicator. The inverse correlation between where the VIX is and what the market is going to do or has been doing is a fairly consistent relationship. On the other hand, when markets are grinding higher and VIX is grinding a little bit lower, which I would argue this is probably a little bit of a grind. This isn't a push to the downside, although today was a pretty big unwind in volatility. That when the VIX is low, there is that possibility that the market moves to the downside, because it would suggest that when there's enough complacency about to push the VIX low, then that complacency leads to the possibility of something changing. Now, here's the thing. Oftentimes that will come ahead of an earnings announcement or ahead of earnings season, where there's a little bit of complacency, but we're in the point where most of that volatility is kind of bled out and we don't have a lot of that increase in volatility because of the overall systemic risk of those earnings. So, especially amongst the leaders, which is kind of what drives the VIX as a whole, as an aggregate, or the volatility numbers of those leaders, if you want to think about it that way. Which is why one of the things that we've looked at before is this comparison between VIX and VIX EQ. VIX EQ, the blue line here on this chart, and that's the VIX of the equal weight, or the average volatility of each individual component of the S&P 500. And you notice that when we were kind of right in the meat of earnings season, that VIX EQ is very high relative to a fairly low VIX. Now those two are coming closer to one another. The fact that VIX EQ is coming down suggests that there's less volatility risk in individual names, and at the same time, less volatility in the market as a whole. We don't have a wide disparity. I would argue that the point in time where the phrase that applies when the VIX is low, it's time to go, is a circumstance like we had here in July, where there is a wide disparity between VIX itself and VIX EQ. because that presents kind of a volatility proposition that one or two of those individual components could see earnings driven movement and could cause kind of a cascade effect of the market, and volatility relatively, at that point, relatively cheap and not a lot of hedging going on. Now we're at a point where both VIX EQ, the volatility of the individuals, is moving down the same way that the volatility of the aggregate is moving down. And that would suggest that the market is fairly comfortable with this level of volatility across the board and isn't necessarily primed for a big move to the downside. That doesn't mean that it couldn't happen. But the impetus for that big move to the downside has somewhat been removed, and that's the impetus that comes from earnings season. So this is an interesting comparison for sure. Speaking of comparisons, one of the ways that we get better at things is we compare what we've done to what we are doing. One of the ways that we can find out how we're doing currently compared to how we've been is if you fill out that feedback survey that's out there in the chat. That's the only way that we know of assessing your perception of these particular webcasts. So a couple of questions and an open field to answer some things. Do me a favor, just fill out that feedback survey. Barb's going to repost that in the chat a couple of times. All right, so volatility is low. That would also suggest that protection against portfolio risk is relatively inexpensive as well. We'll kind of rotate back to that discussion here in a minute. But since we've got limited time until the market closes, I wanted to do a couple of things first. And then we'll come back to that low volatility hedge perspective in just a moment. So let's go over here to the monitor tab and I'll show you what I've got currently working. I put these trades on as an example of zero DTE trades. So I've got really 3 trades on here, and I'll show you. Actually, I've got 4 trades on here, and we'll talk about what these are. So these are all on either SPX, the S&P 500 index, or XSP, which is the micro S&P 500 index. It's just the smaller index, a tenth the size of the SPX. Both have reasonably good liquidity. Both are used oftentimes as vehicles for zero DTE trading. So let's just kind of start with the first perspective. So I might have had at some point during the day a bearish perspective on the XSP, on S&P 500 moving to the downside. So what I did is I took advantage of that bearish bias, that slight bearish bias, in 2 different ways. The first way that I did that was I created a short call vertical spread. I sold the 776, 778 out of the money short vertical call spread. And I did that for 19 cents. My expectation was that the price of the market, with the overall XSP, was going to go to the downside. I'm going to bring in a little bit of premium against not a lot of risk. I mean, 20 cents, 19, 20 cents against $2 of risk, a $2 wide spread, means that I've got about $1.80 at risk against a $20 gain. Well, I mean, that's kind of an off-sided or lopsided risk to reward scenario there. At the same time, it was a highly probable trade because the 776 short call in this case was sitting at about the 15-cent delta. The 778 call was sitting at about the 5-cent delta. So there's not a lot of directional risk here. And this simply becomes, I know that time is going to decay, but I'm simply looking at gamma as a function here to kind of move, if the market moved away from that short strike, I'm looking for gamma to really destroy deltas and really kind of just take away from the remaining extrinsic value in this particular trade. So here we are, about 45 minutes before market close. Sold it for 19 cents. It's currently, this vertical spread is currently trading for about 8 cents. Now, the other thing that I thought about at the same time when I brought in that 20 cents was, okay, if I'm able to sell that short put vertical spread or short call vertical spread, which has a bearish bias, if I'm able to sell that short call vertical spread for about 20 cents, maybe I could take some of that premium that I brought in and I could use it to buy a long put. If in the event that, because this is a gain limited trade, that short call vertical spread, if the market were to dump and just go to the downside, it's got a finite gain, which was the 20 cents or 19 cents that I sold it for. But I had a bearish bias at the point that I put this trade on. So I was looking for the market to move to the downside. So I was looking to take advantage of that by buying a put option. Now, buying a put option, I bought a slightly out of the money put option because it was inexpensive. Bought the 773. So the market had to move to 773 before this really started to gain any intrinsic value. It has not moved to 773. It's currently sitting at 775 in the XSP. So it's not done what I wanted to do. Now we're here towards the close of the day. So I bought it for 13 cents. My expectation was that if the market moved to the downside, I get a big percentage move because the high gamma on that potential trade, the high gamma on that long put, even though it was slightly out of the money, had a higher gamma. If the market moved even slightly to the downside, that gamma ramps up my deltas really fast and it makes it directionally sensitive, which means that this could go in the money very, very quickly and start gaining intrinsic value very quickly if we got to move to the downside. And that delta, remember, delta is going to be the biggest driver of a trade, even as we get close to expiration, like this in those last few days. So it's coming back up a little bit. The market's moving to the downside here a little bit, which is, in fact, we're coming off just a little bit from that 775. We're losing a few cents here. So the long put option, it still just didn't do what we expected. And realistically, I could hold on to that as a lottery ticket kind of idea through the end of the day, but I know what my max loss is the 13 cents that I put into the trade. I didn't pay very much for it. If I were to close it down right now, buying it or selling it back, I can sell it back for about 2 or 3 cents and recoup a little bit of that. I'm not going to just let this go till expiration and lose all of that. I'm going to look at trying to sell this back if I can. But I kind of look at this from the outset and say, well, it kind of accomplished its purpose. I had that there in the event the market moved to the downside. I paid for it by the premium that I brought in for selling the call vertical. And that way I was prepared in the event that the market moved to the downside. Now, realistically, I'm not losing all that much here because I brought the premium in to begin with, and I can close this trade down for about 5 cents. So if we might come out at a wash here as we get to the end, close to this closing time for the day, if I right click and I put in a closing order for this long put, and I'll see if I can get it for, if I can sell it back for a penny, maybe we can push it and test that midpoint. Always a good idea to maybe try to work that to the midpoint there. And I'm going to click on confirm and send and see if we can sell this back for $2 and kind of reclaim some of that. We got it. We got 3 cents actually out of it, which is fine. And again, that's paper money. That's where the midpoint was. Might not happen in a live trading environment. So now we're out of that long put, and I don't have the ability to take that direction move if the market dumps in the last half hour here. At the same time, I'm not at that point where gamma is really, really going to accelerate into those last few minutes of the lifespan of this option. So now I'm going to take this short call vertical spread. It's done by far the vast majority of the work that it can do for me. The most I can pick up still in this last 30 minutes is another nickel. And this is one of those cases where buying it back for a nickel and avoiding the pickle, I think makes sense. And you can kind of see where that name comes from. It's buying this vertical spread back for a nickel. It's done the work that it can do. And it really, the gain that I made here is kind of offset some of that loss that I took in the long put, which was there in the event that the market made the move to the downside, which it didn't do. And sometimes that happens. So I'm going to close this trade down. And this is a typical way that some traders will manage zero DTE trades, is simply using one to offset another and making a directional position. Because The reality of the situation is you've got really two choices in zero DTE trades because you don't have time decay. Time decay is going to be a binary matter. It's going to either be there and then it's going to be gone. And you don't have time for the market to recover if it doesn't move directionally. So you're either going to take a directional assessment or bias, or you're going to take a non-directional assessment and hope that it doesn't move at all. In this case, the expectation that it was going to make a big move to the downside never materialized. So we're going to see if we can get out of this at for a little bit of premium here. Let's see if we can buy this back for 4 cents or better, and click on send, and we'll see if we can buy that back. Now, this is the challenge, my friends. Getting out of vertical spreads or getting out of multiple leg spreads as you get close to expiration. Because right now, if you take a look at where these are, let's look at this on the chain. We are trying to buy back that short 776, and we're trying to sell back this long 778. And both of those are zero bid at the moment. And we're into the closing. This is the problem. Now, look, letting this go to expiration and expiring worthless is not such a bad thing here. Because if I don't have to sacrifice that 4 cents to buy it back, great. The problem is, what happens if the market moves close to expiration? Like really close to expiration, like in the next 30 minutes. Because look at what this gamma number has done. My friends, when I say gamma is going to get you one of these days, if you're not paying attention when you're trading zero DTE options, the gamma on my short leg right here went from, when I put the trade on, it was about 4 cents of gamma. In the last 2 hours, that's gone from 4 cents of gamma to 30 cents of gamma. Gloria Estefan and the Miami Sound Machine had a song, a hit back in the 80s called The Rhythm Is Gonna Get You. If you do not pay attention to where your trade is and where you're going to exit this trade, gamma is going to get you. Either that or Gloria Estefan is going to get you. I don't know, one of those two things, right? But notice what's happening to that gamma. And notice, look, here's the thing. Notice what's happening to the gamma on our long leg. Our long leg gamma is staying just about the same, right? Is staying just about the same. So that being the case, we're not getting a lot of gamma protection on the long leg, but boy, we're getting some gamma risk. Now it's backing off just a little bit, which means that the market's probably going up. We're getting a lot of gamma risk. What does gamma mean? Gamma is the rate of change of delta. Here's how I want you to think about it. Think about gamma as the destroyer of or the creator of deltas. Because if we got a dollar move, look, if we got a $1 move in the index in the next 30 minutes, our gamma, this gamma number right here, which we'll just call 25 cents, would add or subtract 25 cents to this short leg gamma. And so, or short leg delta. And that means this premium is either going to go up or it's going to go down pretty significantly. I'll tell you what, if it moves against us, if this moves towards that short strike, if we get a move to the upside of $1 or even 50 cents, because remember, these don't move in just dollar increments, that gamma is going to start changing that delta is going to start changing really, really fast because of that gamma. That gamma is what influences delta. And our long leg delta is not changing very much because I have very little gamma at that point. Because gamma, especially as we get close to expiration, the curve for gamma goes from a curve that looks like this to a curve that looks like this. It's very sharp, very peaked, and it becomes the destroyer of or the creator of deltas very, very fast. That's the challenge to trading zero DTE trades. So we are at the end of the day, and you notice I've had this order on here, and we've seen the market move by about 4 or 5 cents, and I'm still sitting at zero bid, and there's not a lot of ways for me to get out of that particular trade. So I may just have to live that out, right? And just simply let those expire worthless. The order's in there to close it down. We pay 4 cents to close it down. Even if I were to put that order in to close it down for 10 cents, I'm not going to get it because it's a zero bid. So that's the problem, is that liquidity challenge at the end of the day. So we may end up with that possibility. So it means that if this trade has not closed down in the last hour of the day, last half hour of the day, we're probably going to have to live through the end of its lifespan, which means that we're exposed to that risk until that market closes and stops trading. And there is that possibility that we might not be able to get out of this trade. And we just, now, like I said, if this is a short call vertical spread or a short put vertical spread, and both of these expire out of the money, that's okay, because then we get our max gain. But we also have the possibility. We also have to recognize that possibility of being put in the money, at least on the short leg, fairly quickly. So yes, XSP is cash settled on expiration. I do know how much I'll lose. Why spend money to close it? Because there is that potential risk. If I don't have to take max loss, look, I'm willing. Andres, I was willing to take that maximum loss, but if I don't have to take the maximum loss, I don't want to. So that's why. And it's not to prevent assignment, because these are European style. But if I don't have to take a max loss, I don't want to take a max loss, because the markets could still move. That's the thing. I don't know what the market's going to do. So that's where the drawback to, that's the challenge. And I want to present a fair and balanced approach to trading zero DTE options. That's the challenge. So I've got a couple of others on here. We're going to let that go and kind of live through that perhaps. But the other one that I've got on here really quick, and I just wanted to show you the difference here really quick. We're going to go out to the monitor tab, and I'm going to close down that XSP one. And what I did is I put on two short vertical spreads on the SPX. I put on a short put vertical spread at a $5 wide increment, and I put on a short call vertical spread at a 20 wide increment. Because what I wanted to do is show you the difference between those two in terms of what gamma does and its impact between a wide spread and a narrow spread. Now, first of all, we know that if we trade a wide vertical spread, we've got a larger potential maximum loss, but we're going to have more upfront credit. We trade a narrower spread between the short leg and the long leg. We're going to bring in less premium. We have a smaller theoretical maximum loss in the trade. So look, we sold this one. We sold the short call vertical spread for $1.05. It's now trading for 15 cents. Cool. If we can get out of that, that's great. And on the other side of the trade, where we bracketed this, we sold the $5 wide vertical spread for 35 cents, and it's now trading for 5 cents. If we can get out of that one, great too, right? We can realize a gain on both sides. But what I want to do is I want to go over to the trade tab real quick and take a look at SPX and see what this looks like. So this is our zero DTE position here. Here is our wide spread on the call side. We sold the 77.65. That's this one right here, 77.65, and we bought the 77.85. So now we're kind of at that point where gamma is going to start to increase, right? And I'm going to grab my annotation tool here, and we're going to take a look at gamma. So you can see what gamma's done. Because this has moved a little bit further out of the money, gamma on the long leg has gone to zero. Gamma on the short leg has moved from 3 cents, or actually 4 cents when we put the trade on, down to 1 cent. Remember what I said about the gamma curve? As we get close to expiration, it's very peaked, very steep, and very narrow, which means as we roll off of that that at the money position, as this moves further out of the money, right? As this moves further out of the money, this gamma number is going to decrease and decrease rapidly. It's gone from 3 cents down to 1 cent. The nice thing about that is that takes us to that position where unless the market makes a bigger move, unless the underlying makes a bigger move, it's not going to destroy or create deltas very fast at this point. Now, the other thing to think about is gamma changes too, right? We know that gamma as an option Greek changes as well. That third order Greek, because gamma is a second order Greek. Third order Greek is speed. Speed is the rate at which your gamma changes. So we start to get close to expiration. The cool thing about speed is that speed is a sharp bell curve as well. And so until we get close to that at the money position, that gamma is not going to increase very fast, which isn't going to increase the delta very fast. Now we're getting deep into the speed weeds here. So that's a whole different problem. But I just wanted to kind of, bring this to the discussion, because now we're at a point where this wider spread for this short call vertical spread maybe gives us a little bit of an advantage from that standpoint, because we're bringing a little bit more premium. We could bring it a little bit further away from the at the money position when we sell it and still collect about the same amount of premium. Makes it a little bit more efficient as we get close to expiration in terms of potentially taking a loss. Now, on the other side of the coin, however, we sold the short put spread with a $5 wide increment. We brought in significantly less credit to begin with. We brought in 35 cents of credit to begin with. Smaller theoretical maximum loss. But here's the thing. Both of these trades, both of those legs have the same amount of gamma. And because they're so close together, that gamma is going to stay there because it's going to impact on that. It's going to help us on the long leg. It's going to hurt us on the short leg if price starts to move towards that short strike. So this may have a narrower spread between your short and your long legs in a short vertical spread on the zero DTE strategy, may give you a gamma advantage, even though you're bringing in less premium to begin with, because that long leg is going to increase in deltas where the short leg decreases in deltas at about the same rate. So it kind of neutralizes some of that impact of gamma, if that makes sense in this particular case. So you can choose to do it one of either these two ways. You can build a wide spread between your short and long legs, or you can build a small spread in between your short and long legs. One may be more directionally sensitive, at least at the outset. If it goes against you, the wide spread between your long and your short maybe has a little bit of an advantage in terms of the amount of premium you're bringing in, whereas the narrow spread between the short and the long legs maybe has an advantage in stabilizing gamma. And gamma, Ricebird, yes, because speed is positive and increases as we get closer to expiration. So the closer we are to the end of the day, the faster that gamma increases or decreases. Speed is going to increase to that point. So delta is the first order derivative. Gamma is the second order derivative. Speed is the third order derivative, and it influences the change in gamma. Wow, we got deep into the weeds. All right. Hey, we've got just enough time to talk about this, our zero DTE, or excuse me, not our zero DTE strategy, but the 14-7 strategy. So I'm going to pop over here to the charts. We're going to bring up our index grid really quick, and we're going to rock through this really fast. Okay, so this is our S&P 500 index grid. I'm going to go over here to the monitor tab, and I've been keeping up with this. So here's my index options weekly, and I sold this vertical spread for about $2 last week. Last Wednesday, I was in Florida doing a branch event, and I sold it during the middle of that branch event. It is now currently trading for, we're going to have to pay $5.10 or $5.15. Let me just bring up my calculator here. So we're going to have to pay $5.10 minus $4.20. So we can buy this back for about 90 cents against the $2 that we were paid for it to begin with. So we'll make about $1.10 in this particular trade. So I'm going to close this down. Right click. We're going to do that. Right click, and we're going to create a closing order. I can buy that vertical spread back for about 90 to 95 cents. I'm going to push that a little bit towards the midpoint and work that order a little bit. See if we can get that, close that trade down for about 95 cents. and get the majority of what we were paid for it. We'll see if that closes down. Now I want to go back to the chart and I kind of want to see where we are. So our expiration at 14 days to go is the 26 AUG expiration. So we're going to take our vertical line and I'm going to push this out to the 26th of August. That's right there. And I got to move this label because it's right in my way. Now we'll draw a line right here. That's going to be at the 75.35 strike. There we go. We got out of the vertical spread. 75.35 is our short strike. So we're going to go over here to the trade tab. And I'll just show you how we'll do this really fast. Connie, I know, has been doing this before, but here we are. We don't have a 75.35. I've got a 75.30. So I'm going to go to the 75.30. Wow, that's about the 4-cent delta. There's the product right there, my friends, of low volatility. Our 75.30. No, you know what? Wait, hang on. Never mind. I was way out of the money. I was going to the 73.30. 75.30 is right here. That's the 11-cent delta. But again, the same thing. That's an 11-cent delta because volatility is so low. The VIX is so low. So we're going to go 75.30 and we're going to buy the 75.10. So it's 20 wide. $1.30 against a 20 wide spread means that our risk is going to be about 1,800 in this trade, bringing in a $1.35. We're at the 11-cent delta, lower probability of getting in the money. And we're going to put this in our index options weekly group, and we're going to send that off. And we got a $1.40 for it. Cool, without even working it. Thanks, Barb, for catching that. Yep, I got that. All right, there we go, guys. Hey, fill out that feedback survey. Let me know what you think. Here we are now, 14 days to go until expiration. We sold it for $1.40. Nowhere near what we've been getting because we've been getting about $2. But again, that's a product of 14 VIX. And that's how those things go. Volatility low, not going to get as much premium, but higher probability that it doesn't move into your spread. Volatility high, you're going to get more premium. And there's a greater risk that you get movement. That's the nature of volatility. There's no free lunch there. Now, I tell you where there is a free lunch, guys. You know where there's a free lunch? If you come and join us for our live events, we're going to be in, hang on, let me bring this up real fast. We're going to be in New York in just a couple of weeks doing a live event, our Advanced Option Strategies workshop on the 28th and 29th. There is a free lunch there. If you come and join us, this is no cost to you to sign up. We're going to buy you lunch. We're also going to buy you breakfast. I'd love to have you be there with us. And then we're going to be in Scottsdale, Arizona as well. So some great stuff coming up. Check this out over on schwab.com/events, and you're going to find all of these live events. And then the other thing that I'm going to ask you to do is come over here to the Trader Talks webcast page and join us here on the webcast page. If you have a question about Gamma or index options or about zero DTE trading, just type in what you're looking for. Gamma right there, and just do a search real quick. And there you go. Delta, Gamma, Theta, Vega, Gamma, and the color of zero DTE options. Zero DTE short vertical Gamma grab, zero DTE long options. So I've talked about Gamma quite a bit in a bunch of different ways. So join us over there and get some insight into some of those topics that maybe you are looking for. Wow, look at that. That's us right there in that live one showing up on the list. My thanks to Barb Armstrong for helping out. My thanks to all of you for being here and joining us. If you're in the recorded version, thanks for joining us as well. My thanks to Connie Hill for letting me play around in her webcast and talk about some fun stuff. Gamma is interesting, guys. Just think the rhythm and the Gamma is going to get you. Think Gloria Estefan when you think Gamma. Have a great day, everybody. We'll see you soon. Take care. Bye-bye.